One phone call, the beginning of the end. On the afternoon of 23rd September 2008, as the world wobbled on the brink of a financial meltdown triggered by the bankruptcy of Lehman Brothers, a major global financial services firm, a man made a phone call that would irrevocably alter the course of his life. A blockbuster corporate decision. That afternoon, the boardroom of one of Wall Street's most prestigious firms buzzed with urgent deliberations. Now, decisions made in these hallowed halls were supposed to be tightly guarded secrets, meant only for those within this fortress of high finance. However, without his colleagues knowing, this man dialed a number, setting off a chain reaction of events, ultimately leading to one of the most high-profile insider trading criminal cases. A conspiracy unfolds. On the other end of the line was this man's friend, a hedge fund titan known for his aggressive stock trading strategies and insatiable hunger for market-moving information. The ensuing conversation between the man from the firm and his hedge fund titan friend was brief but potent. It was also full of risks that neither could foresee at the moment.
Just got out of the meeting.
The man from the firm spoke into the phone, the weight of the day's discussions still hanging heavy in his voice.
Something big is about to happen at Goldman.
The words that followed were a revelation, a peek into Wall Street's inner workings. The man then divulged a confidential board decision about the legendary investor Warren Buffett's Berkshire Hathaway infusing $5 billion into Goldman Sachs. A fortune is earned. As the man from the firm hung up the phone, the significance of his actions may have only faintly registered on him. Yet, this information was pure gold for the hedge fund manager on the other end. He swiftly moved to capitalize on the information, executing stock trades that would yield him profits of over $800,000 once the news became public. This clandestine transaction, however, was not as secret as they believed. The conspiracy is detected. Federal investigators, already suspicious of the hedge fund's trading patterns, had wiretapped the hedge fund manager's phone as part of a broader probe into insider trading. The recorded conversation was a smoking gun, a direct link between the confidential boardroom information and illicit market activities. As the case unfolded, the wiretap revealed the caller's identity. It was none other than Rajat Gupta, the then managing director of the consulting powerhouse McKinsey and Company, and a towering figure in the corporate world, respected and admired as a man of integrity and brilliance, as a leader who had scaled the heights of corporate America, the fall from grace. However, on 15th June 2012, Gupta was found guilty of securities fraud and conspiracy. The once revered executive was sentenced to 2 years in prison, a $5 million fine, and experienced a significant fall from grace. The phone call on that fateful afternoon was not just a slip of judgment, but a decisive moment that marked the beginning of Gupta's end. Raj Rajaratnam, his hedge fund friend, was also convicted on insider trading charges and was sentenced to 11 years in prison. The moral of the story: Rajat Gupta's saga serves as a powerful reminder of the dangers of using privileged information to gain an unfair advantage for oneself or others, an act that experts call insider trading. But what exactly is insider trading and why is it such a serious offense?
These are some of the questions we'll answer in our upcoming videos.